Let's be honest for a second. Most people say they want to invest, but when it's actually time to start, they freeze, they overthink, they watch dozens of videos, they wait for the perfect moment, and months later, they still haven't invested a single dollar. Meanwhile, the people who started early, even with small amounts, are quietly building wealth in the background. So in this video, I'm going to show you exactly how to start investing step by step, even if you're a complete beginner. No complicated jargon, no fake get-rich-quick strategies, just a practical system that works in the real world. And by the end of this video, you'll understand how people turn small investments into serious long-term wealth. Let's get into it. First, let's fix the biggest lie about investing. A lot of people think investing is only for rich people. That is completely outdated. You don't need thousands of dollars. You don't need to be a financial expert. And you definitely don't need to predict the stock market. What you actually need is consistency, because investing is not about hitting one lucky trade. It's about building momentum over time. Think about it like this. If someone invests $200 per month consistently and earns an average return of around 8% per year, in 20 years that could grow to well over $100,000. Not because they were a genius, but because they started. That's the part most people delay. They wait for confidence, but confidence usually comes after you start, not before. Step 1. Fix your financial foundation. Before you even think about investing, there's one rule you need to respect. Don't invest money you might need next month. Investing works best when time is on your side. So before investing heavily, focus on two things. First, eliminate high-interest debt. Credit cards charging 20% interest will destroy your progress faster than investments can grow. Second, build a small emergency fund. Even a few months of expenses can protect you from needing to sell investments during a bad moment. Once those two things are handled, you're ready for the next step. Step 2. Open an investment account. This part used to be complicated. Now it takes about 10 minutes. You simply open a brokerage account. This is the platform that allows you to buy investments like stocks, ETFs, and other assets. The key here is choosing a reliable platform that offers low fees, easy access, and beginner-friendly tools. Once your account is open, you can transfer money directly from your bank, and now you're officially ready to invest. But here's where beginners usually make their biggest mistake. Step 3. Stop trying to pick the perfect stock. Let's be real. Social media makes stock picking look easy. Someone posts a screenshot of a trade. Everyone else thinks they're missing out. So beginners start chasing random stocks hoping for quick gains. That approach almost always ends badly, because even professional investors struggle to consistently pick winning stocks. Instead, beginners should focus on something much simpler: broad market investing. This usually means investing in funds that track large parts of the stock market. These funds spread your money across hundreds of companies at once, which dramatically reduces risk. Instead of betting on one company, you're investing in the overall growth of the economy, and historically, that strategy has worked extremely well over long periods. Step 4. Use dollar cost averaging. This is one of the smartest habits you can build. Dollar cost averaging simply means investing money consistently over time. For example, investing every month or every paycheck, instead of trying to time the market. Why does this work? Because it removes emotion from the equation. Sometimes you'll buy when the market is high. Sometimes you'll buy when it's low. But over time, your average cost evens out. And more importantly, you stay consistent. Consistency beats perfection every single time in investing. The real power of investing. Compounding. Compounding is where things start to get interesting. This is when your investment returns begin generating their own returns. Think of it like a snowball rolling down a hill. At first it grows slowly, but over time it gains momentum. This is why starting early matters so much. Even small investments can grow dramatically given enough time. And this is also why waiting until you make more money can cost you years of compounding. Time in the market beats timing the market. Every single time. The mindset that separates investors from everyone else. Here's the truth most people won't tell you. Investing is not just a financial skill, it's a behavioral skill. You have to learn how to ignore short-term noise, you have to avoid hype cycles, and you have to stay disciplined when others panic. That's not always easy. But that discipline is exactly what builds long-term wealth. Because while most people are reacting emotionally, investors are building systems. If you found this video helpful, subscribe to Daily Dividends for more practical investing and personal finance strategies. And comment below, what's the first investment you're planning to make? Because once you take that first step, you're already ahead of most people. I'll see you in the next video.